Sorry for the late start. My chairman has just advised that we are 6 minutes late, so we should get moving. A very warm welcome to everyone in the audience today. And we do have a webcast also going on today, so a welcome to the people on the webcast as well. And we will allow people on the webcast to cast questions later on, and hopefully we can field their questions. I think, for those of you that have had time to squeeze the SENS announcement this morning, I think we have a very solid set of results. I think we are, making headway towards our strategy. Our strategy obviously has always been to strengthen our balance sheet, reduce gearing, make sure that we've got adequate fixes in place with obviously anticipated interest rate rise cycle and cost of capital going up. So I think we management and certainly the board of this company has got a few key items that they are managing. Unfortunately, my usual colleague Bronwyn is not here. She's out on roadshow in Delta, so she will be sorely missed today. I think we'll give an update with that regard in terms of finding a replacement. I think we've had very, very good progress. We've interviewed 6 candidates, and I think we should be making an announcement in that regard very, very shortly. We do have quite a lot of stuff to go through today, so without further ado, I think let's try and go through the results. Just a quick introduction. Delta continues to be a sovereign underpinned fund. 74% of our revenue comes from government. And it's something that, the board took a strategy last year, probably from a timing perspective, from a PR perspective, it could have worked out a bit better. But look, I think we are of the view that the strategy is solid, and I think it's a long-term strategy rather than a short-term strategy. So I think the ongoing opportunities that still exist in that area offer, a fair challenge. We've always said, a fund like Delta, not being in retail, not being in the high growth part of the economy, is a steady fund. We're looking for that steady growth and consistent growth and a certainty of cash flow. That's the type of investor that will be investing in Delta. Our diversification into Delta and Mara Delta as of Friday last week. If you recall, when Delta Africa, as it was called at the time, our shareholding was actually sitting above 58%. That has come down significantly as a result of numerous capital raises that they've undergone. I think the merger with Pivotal is now well and truly underway, and I think there's obviously further action to happen there. So as at year end, we are sitting with 26.3%. We don't anticipate that in the short term that will increase. It's probably more likely to decrease as we focus on strengthening our balance sheet. And obviously they are going through quite an aggressive growth phase at this stage. So we do anticipate that shareholding probably during this financial year, or the new financial year, will probably dip down below 20%. And I'll talk more about that later on. I think market cap at half year was sitting at 3.5 billion rand. As of today, it's hovering at the 4.7 billion rand mark, and I'll talk to that as well. I think there's been major sentiment around share price movement and so forth, and I think we took quite a big hit in November with change in treasury and finance ministers and so forth, and that sentiment is still very much part of our daily lives that is still in the market at the moment. Our key nodes, where we've constantly focused on and continue to be playing, is Pretoria CBD, which has become, which is historically and will continue to be a very, very key node for government. Will be Pretoria. Durban has become quite a key node for ourselves. we've acquired some very large assets there. We're starting to get some serious traction, particularly from a synergy between Pietermaritzburg and Durban. And again, once we touch on to more detail in terms of the portfolio performance, I'll touch on that as well. For those of you that are joining us for the first time, this number, as we've always mentioned, has been a key number. The value of our properties sitting at about 100 million is our key magic number. And we basically use this number as a barometer in terms of the size of properties that we wanted to get. So part of our disposal list, there are some smaller government tenanted assets that are sitting in our disposal list, and that's predominantly because they are sitting way below that 100 million rand per property. Our total assets, they did increase quite significantly. This number here still excludes the Redefine transaction and only has a little bit of the Orthotouch, as we refer to it as the Free State portfolio, but we'll give you more detail around that a bit later on in the presentation. Just, I think for those of you that have booklets, I think our history is very, very well documented. I think we took in a very aggressive strategy to grow the fund. We saw an opportunity, a gap in the market whereby some of our competitors were exiting the sovereign underpin space. We saw that as an opportunity because regardless, no matter which political party is in office, in our view, government will always need basically officers. And I think our business model is based around government rather than an individual government political party as such. So government will always be around unless something drastic happens. Just a snapshot of the fund at year end. And I think there's a lot of information here, but I think the key thing here obviously is the sentiment. The share price moved from 890 at the end of 2015 to 650. I think speaking to the sentiment, probably some challenges that maybe fund managers were seeing. I think we have a very clear strategy in terms of our own ability to deliver on what we have communicated to the market in terms of our long-term strategy. It is a long-term play. So whilst this is a worry, in terms of the sentiment, we are hoping that, I think through producing the type of results that we have today, people will start to understand the business slightly more. The other key number is the value. It's the net NAV. It's ticked up quite nicely. Again, it's something that we don't really want to focus on in terms of the discount to NAV. I think the market can make up their minds in terms of where the appropriate risk versus reward should be. But, we think that the fundamentals of the fund, the strategy is very, very solid. And I think as we resolve some of the challenges and headwinds that have historically been facing the fund, that should narrow going forward. Another key number at year end was obviously the reduction of debt from 49.9% to 47.2% at year end. This did drop after the Redefine transaction to around about 42%, as we had indicated to the market that we do anticipate that number to continue to reduce to sub 40%, which is where ideally we would like to be. I think Shanil will talk on the level of fixes in terms of how we got there and some of the initiatives that we have undertaken in that regard. So some of the key highlights for this reporting period, as we've already announced via the Ascends announcement, is the 8% growth year on year in distribution. This is online with our guidance that we gave early last year, and I think it was not easy given the negotiations in terms of less escalations with some of our key tenants and so forth. So we needed to look for other avenues, like filling in vacancies and so forth, to make sure that we are able to achieve that growth in distribution. But again, I'll touch on that a bit later on. After redefine, as I already mentioned, the gearing has come down nicely from 49.9% in February 2015 and come down even further from February 2016 to 42.3%. Our level 2 BE rating is very important for the sector that we play in. State-owned enterprises, government organizations like SARS, this is very, very critical for us to maintain that level, especially with the new codes. We do have a new, I don't see him in the crowd, but we do have a new procurement officer who comes from DPW Gauteng, basically making sure that our strategies and policies are very much in line with where government is thinking in terms of procurement and strategies like that as well, in terms of expenditure. As already mentioned, I think we've concluded 2 major transactions without having to raise any additional capital. This has allowed us to bring down the gearing significantly. I think already I can assure the market that the reletting of these portfolios or extending some of these portfolios has already started in earnest. We're starting to see some very interesting feedback, and obviously given our capex regime, and which we'll talk about through our numbers, I think we're quite certain that we definitely did the right transaction for Delta. Our A2 credit rating by GCR was reaffirmed, and again, I think the reason why this is not only an A rating is that number here needs to be below 40%, but Shanil may touch on that in his presentation. Given us that we do play in the CBD area, we managed to retain an 80% retention of our existing tenants in terms of leases that expired. The 20%, I think there was somebody that asked the question, does that mean the 20% exited? No, not at all. All it means is that those negotiations are still underway and have not been concluded, and we anticipate that those will be resolved in the next month or two. The bulk of those renewals are sitting in Polokwane, in some of the smaller towns, in terms of what the rentals are there. In principle, we have probably found each other with the government departments in terms of the rental. There has been no rent revisions, but it takes a bit of time between the region and the national department to obviously get the requisite signatures to get signed off. Just some feedback in terms of some of the key deliverables which we had mentioned last year. If you could remember, I think we had Greg Booyens who had left us towards the end of the year. I'm very happy to announce that Shanil had joined us in December. He's hit the ground running. I think he's tried to grasp as much as possible, not coming from a property sector, but I think he's technically very, very astute gentleman, and I think he's very, very passionate about the business. And so, I think his passion is something that has surprised definitely myself and Bronwyn, and certainly the board. And I'm sure that as he acclimatizes from property fundamentals and understanding how property trades, not being a property person, I think you'll learn to understand why the board felt he was the right person for the job. On the disposals front, we mentioned last year that we had a 1.4 billion rand disposal list. 659 million rands of those disposals has been concluded. About 174 million of that has already transferred. with about a 550 odd million still waiting to be transferred. But it's progress in that disposal list, which again, I think we are focusing on making sure that that capital is then redeployed. A question that keeps coming up is the proceeds from these disposal, where is that going? Partly, as we've already mentioned, we've got quite an aggressive capex regime. So part of that, the windfall, part of the windfall that is coming out from the disposals will be used towards capex and obviously reducing our gearing as well. But I do not want to take Shanil's thunder. I think we can. He'll give you more information in terms of exactly what the split is between, debt, what our gearing, what our capex budget is, and how we intend to fund that going forward. I think the capex, is something that we take quite seriously. I do see Trevor and Andries Andries Schoeman here, who I'll give you more details about later on. I think we've made sure that it's becoming quite a key component in terms of one of our strategic competitive advantage, making sure that our buildings are first and foremost meet the minimum health and safety requirements that government requires, and but even more importantly, that we can dovetail our capex to basically generate a decent return for our shareholders. We will continue to be a dominant sovereign specialist fund. I think if you recall, we took a view that given the forward yield that Delta was trading at, it just didn't make sense for us to be trying to chase retail assets or industrial assets. We just couldn't compete. Given the composition of our fund, we think that, and we know that our competitive advantage is certainly within the sovereign underpinned environment, and I think we've tried to engage as much as possible, along with people like our people from the sector transformation committee. To make sure that we are always ahead of that in terms of making sure that we are positioned very, very well to obviously benefit from preferential procurement in terms of government strategy. So it's not easy, and I do see the transformation lady from the industry in the audience, and I think those of you that want to understand about where government is going, the sector, what initiatives are going on. There's a myriad of discussions happening behind the scenes, not only from ourselves, not only from our competitors, but just as a sector as a whole. And I think we're making slow but good progress. And I know that we're probably not making as much progress as some investors would like, but certainly government doesn't move very, very quickly. And sometimes that's a good thing, particularly when it comes to exiting buildings as well. As already mentioned, I think our holding in Mara Delta is ongoing. Okay, I'd like to introduce Shanil. Shanil will take us through the finances, and then I'll come in to take you through the balance of the presentation.
Thank you for the introduction, Sandile. Yeah, I guess as Sandile has mentioned, just over 4 months into the hot seat, it's been fairly challenging coming from an environment outside property, but learning the fundamentals, I think, has been outstanding. It's been great. The learning experience has been a tremendous learning experience from my perspective, and I'm actually happy to have made the decision to join Delta. So I guess, yeah, my first time on the podium, bringing Delta's results to the fore. And I think Sandile downplayed our achievement a bit when he said a solid set of results. I actually think it's a fantastic set of results to have achieved the growth that we have achieved this financial year within the trading environment that we've experienced. So without further ado, I think just to take you through some of the financial highlights for the financial year ended 2016, I'm just going to touch on the highlights here because I'll be explaining them in further detail through the slide. So I think growth in assets of 1.6 billion under management, you would concur, is a significant achievement for our portfolio. Weighted average cost of debt, 8.75%. We're still well contained within a 9% mark. Disposals, 660 odd million rand, which Sandile has touched on as well, of which we've transferred 108 million, and there's 551 million of our assets held for sale that's been concluded at year end. Excuse me. Gearing reduction, I think this is one of the highlights for us this financial year. Post financial year end, the conclusion of the redefined transaction has gone a long way in helping us achieve the reduction and in achieving our ultimate aim of 40%. Fixed debt, 83%. I'll touch on that further in the presentation. And our extended average fixed period, 2.13 years, up from 1.91 at year end. Okay, I think so just on the 4-year review that we've populated, running down the line items. From a revenue perspective, I think you would note the growth in revenue, 29.8% to be exact. And I think that growth benefited substantially from acquisitions that have been concluded during the financial year, in conjunction with increases that we've managed to obtain on the existing portfolio. I think our weighted average increases amounted to 7.84%, which you would agree I think is quite a good number versus all of the sentiment around government and the talk within the industry. Net, I think our net property income as well, if you look at our net cost to income ratio, that's gone up marginally. It's gone up by about 2%, which obviously had an impact on the net property income. And that was primarily due to the acquisitions that were concluded during the financial year. I think we expect this position to normalize once Delta takes management over the assets and undertakes a lot of the redevelopment work that's required on the new acquisitions and the portfolio, especially the Free State portfolio that we've recently acquired. Investment property, looking at the growth that we've experienced, there's been a combination of factors as well that contribute to the positive growth in the portfolio. Notably, the acquisitions that were concluded during the financial year, 1.1 billion to be exact in total. A significant part of that, as Sandile alluded to, was the Free State portfolio, or the Orthotouch portfolio. We've also had quite a bit of capex investment into the existing portfolio. We've spent about just over 300 million rand. That's obviously been capitalized. And at year end, we've had a fair value uptick on the portfolio as a whole of another 300 million. So I think just between the acquisitions, capex, and the fair value adjustment, that has contributed to the 1.6 billion rand growth that we see in the portfolio. Listed securities, Listed securities, I think just to highlight, that represents Delta's interest in Mara Delta. As some of you may know, Delta International, Delta Africa, and the progression of recent to Mara Delta. The shareholding in this list, in Mara Delta, I think initially we started off in the prior financial year, it was a subsidiary. We held in excess of 50% of the issued share capital. In light of the extensive growth, as Sandile highlighted as well, that Mara Delta has embarked on, and some of the capital raise, our effective shareholding did dilute, particularly in April 2015, where our shareholding diluted to just over 31%. At that stage, we obviously, it was a loss of control of a subsidiary, so the Mara Delta was deconsolidated and has since been equity accounted for as an associate. Up to year end, there was further dilution, obviously due to further capital raise that took place within the business. We also purchased a small bucket of shares in February. We purchased about an extra 400,000 rand, resulting in our net position, our net interest at year end, amounting to 29.34% to be exact. Post-year end, there was a further capital raise, as Sandile mentioned earlier on, which effectively at this point, we stand at a shareholding of 26%. Borrowings, I think our borrowings have increased by just over $500 million, and that's obviously in light of the acquisitions that we've concluded during the financial year, combined with some of the capital projects undertaken, which came from the portfolio itself. So that particularly has been responsible for this $500 million increase in our debt facilities. Gearing level, I think as mentioned by Sandile as well, the progression from last year to the current year, I think this has benefited from quite a few factors in our business. Disposals, we've had a bit of disposals that we used to pay down debt. The business embarked on a capital raise during the financial year. I think we raised approximately 650 million between a capital raise and vendor placements. So a large amount of that proceeds was used within the debt facilities and capital projects undertaken during the financial year. The 47.2% position, as I would highlight later on, has improved to 42.3% after our widely publicized Redefine transaction for 1.26 billion, which was purely a share issuance transaction. So the benefit is actually it's actually a fairly tangible benefit on our LTV ratio, as I will demonstrate later on. Weighted average interest rate, I think the increase within our weighted average interest rate is aligned with the market environment, the increases that we've experienced during the financial year. So that's primarily the market conditions that have ticked up our interest rates from 8.1 to 8.75%. Average debt expiry, this has decreased marginally. I think in the prior year we were 2.37, we're now down to 2.3 years. And I think from a management perspective, our intention is to obviously extend this expiry period. We're obviously looking at various scenarios that can help us achieve this extension. And I think refinancing of the facilities, utilizing proceeds from disposal are going to assist us in trying to improve on this average debt expiry period. Sorry, am I confusing? The debt expiry period, sorry. Average debt fixed expiry, 2.13. If you look at the progression since interim, we've actually improved. It was 1.97 at interim. It's improved to 2.13. And I think a big part of that increase is due to quite a bit of interest rate swaps that we concluded in February. To be specific, we did R1 billion worth of swaps. Average cost of 8.1%, excluding any margins. And effectively, that helped us increase the weighted average up to the 2.13 years that's displayed on the slide in front of you. We've also, in terms of our fixes, you would see that 83%, I think the R1 billion worth of fixes went a long way as well to helping us elevate that number, which effectively, I believe, puts Delta in quite an attractive position. 83% of our debt being fixed. This excludes the revolvers, which we've historically reported on. So I think if you include the revolvers, we're sitting at about a 70-30 mark. But 83% is the number that we see as being fixed in the business at this stage. Net asset value per share, I think as Sandile has touched on that as well, 10.61, I think that's been an increase of about 6% over the prior financial year. And I think, just to mention, if you look at our closing share price at 650, I mean, that's over a 61% discount to the NAV of the ruling share price. And I think for us, there's quite a bit of, we understand the whole sentiments behind the business, but we would actually like to see a good re-rating of our share price that approximates our net asset value going forward. Okay, and then just the growth in distributions. I think it's always good to see a slide like this with an upward trajectory, as you would agree. Delta's growth. And I think, yeah, it's management's intention. I think as Sandile has alluded to as well, forward looking for the next financial year, it's going to be turbulent times, uncertain economic climate, rising interest rates. So all of the dull and gloom, but I think management is still confident that based on our portfolio, based on the management of our existing portfolio and the new acquisitions, we should be able to keep this growth trajectory going forward. Okay, just on the distributable income statement, I think I've covered quite a bit of the explanation in the 4-year review, but we'll just highlight some of the outstanding that hasn't been spoken to. I think administration expenses, we see quite a marked increase. I think a big part of that for us is that we've had a 10.1 million rand reversal of a prior year accrual. So that's a big part of this 30 million increase that you see in front of you. Also, with regards to our increased size of the portfolio and the acquisitions that we embarked on during the financial year, asset management fees and professional fees have contributed to a bigger part of the balance in the increase of administration expenses. Foreign exchange loss, this is a small realized portion that we have. We've got dollar-denominated debt with the Bank of China. So effectively, that relates to the unrealized portion of that loss that we've added back for distribution. Dividends, I think as Sandile has alluded to as well, this is the dividends from Mara Delta, effectively dollar-based. So we see an element of hedge to the Bank of China loan, which was obviously taken out in anticipation of acquiring these shares. And I think from a Mara Delta perspective, 36 million rand is obviously a 33% growth in their half-year distribution, which I think is also very, very exciting and very encouraging regarding our investment. And I think, we hope, going forward, we hope to benefit from continued distribution growth out of Mara Delta. Sundry income, I think just to highlight, there was a big part of that is a fee charge on a cash guarantee that we provided to Mara Delta, and that has since been settled. But that effectively forms a big part of the sundry income. Debt structuring fee, that's with regards to all of the facilities in play with the acquisitions that we have performed during the financial year. Antecedent interest, that relates to the new issuance of equity during the financial year, pertaining to our acquisitions as well, that was concluded, namely Absa Florida, Veritas, and the Parkmore buildings, which I believe have been communicated prior as well. Okay, and in summation, that provides us with our distributable income of 487.9 million for the year, which translates into the 8% growth, 90.79 cents per share. Statement of financial position. I think we've covered the investment property part quite extensively in the 4-year review. So just working our way down the balance sheet. Investment in associate. That number. That's our investment in Mara Delta post the deconsolidation. So effectively, that the value you see up on the screen is the carrying value of the investment. At the date, we lost control of the business as a subsidiary. It also includes the further shares that we acquired in around February, a further 460,000 odd shares, and obviously the equity profits and our share of other comprehensive income, including the dividend declaration that came through out of the business. Other non-current assets, 17.7 million. You see on the slide, effectively that's our property, plant and equipment of just over 4 million rand, and then the interest rate swaps that we have, fair value of 13 million rand. Okay, so the big ticket, the assets held for sale, the 1.4 billion. I I think as I've discussed earlier on as well, it's a makeup of approximately 17 properties that has been marked for disposal. And I think, like we've mentioned before, the intention is that the proceeds from disposal will obviously go a long way to settling some of the facilities that we have in place for the properties that are funded, but also to support our capital projects that's envisaged for the financial year. Of the 1.4 billion, about 551 million of this has been committed to sale agreements at year end. And I think we are fairly confident the balance of the portfolio is currently under consideration, and we should have this concluded before financial year end. Equity, I think if you look at the significant movement in equity, it's a combination of factors. I think it's the capital raise that we performed during the financial year. In total, we raised just under 660 odd million rand. It was a capital raise performed in April and in May. We also had a election for share reinvestment when we on the first distribution, and I think quite a few shareholders took up that option, resulting in a further 45.2 million rand flowing to the business. And I think another major part of the movement is attributable to our share buybacks that were done during the financial year. We bought back just under 13 million shares at an average price of 761, totaling just over 98 million rand. Non-controlling interest, I think in the prior year, that was when Delta Africa was a subsidiary. So obviously that's been realized once you've had the loss of control. Non-current liabilities, I think I will address the debt facility in the next slide. Okay. So I think just under current liabilities, I think the biggest portion of that relates to our current debt profile. There's a small portion that pertains to payables, trade and other payables of about 100 million, and cross-currency swaps and a bank overdraft that we have in play in the business at year end. Okay, so coming to our debt summary. I think this is the debt profile within the business. If you have a look at our banking facilities, we've got just under 4.3 billion worth of banking facilities, 805 million worth of revolvers. If you look at our debt capital markets, the amount of paper we have out there is just 750 odd million. There's a small vendor loan that settles at the end of this financial year when we bought, I'm just trying to get the, when we performed an acquisition during the financial year. So that will be settled in around February. I think if you had to run down our non-current borrowings that we have in the business, I mean, in total, the long term that was displayed on the previous slide of 3.6, short term of 1.5. So I think for us, the bigger focus lies in the short term of 1.5 billion that's expiring in this financial year. And I think just to give you a brief overview of that, 462 million rand is a secured note, which is included as part of the 650 million rand DMTN program. That's secured by assets of just over 1 billion rand. That expires in December, and we're hoping that will be rolled over. This 100 million rand fixed note actually expired in May, and that was settled. There's a balance of 64 million rand worth of commercial paper that we have as well, which expires in August 2016. And I think, depending on the market conditions prevailing at that time, we will take a decision whether to roll or depending on the timing of some of our proceeds from disposal and how that actually plays out. I think the balance of our facilities that are in short term, which relates to bank facilities, of about 809 million. Of that, we've already refinanced about 380 million. The balance will be expiring between August and financial year end. And I think some of those facilities, in light of the disposals, will be paid down, and the balance we would look to refinance. Okay, so just back on the slide, I mean, if you look at the fixes, we've got 3.5 billion rand worth of fixes. Our borrowings, including accrued interest, of just under 5.1 billion. So excluding the revolvers, that is how we come to our 83%. And obviously, just as a comparative to prior year, the fixed percentage, including the revolvers, with our weighted average cost of debt of 8.75%. Okay, and lastly, this is just a graph on our debt expiry profile. I think we've spoken to the financial year ahead of where the 1.5 billion lies and the makeup of the 1.5 billion, and obviously management strategy on how we hope to address this going forward. Okay, lastly, in the heading states pro forma. This is actually emphasizing the LTV. So I think in this slide, when management put this together, our focus was on the debt, on the cash, the disposals, and effectively how this is going to help us achieve our LTV ratios that we would like, that we would like to see the business operate at. So I think just if you look at the investment property, the increase is in line with the redefine, 1.2 billion redefine. If you look at the movement to Feb 17, there's another 776 million, which includes the additions that we have, the capital projects that we estimate to be just under 300 million. And we've very conservatively built in a 4% uptick in the fair value of the property portfolio before year end. The non-current assets disposal, like I mentioned before, we're hoping for that to materialize and to be completed before year end. We've applied a slight discounting based on the cash flows that have gone into the revolvers and to settle down some of the debt. It's a combination of deals that have already been concluded and signed versus those that are outstanding. So we've almost estimated an 80% realization of the value, which is about 1.25 billion. And this is what we obviously will utilize to reduce borrowings on existing and obviously to put into our revolvers as well. Just to comment on the equity movement that you see on the slide, that's primarily because of the redefined shares which have been issued, and obviously partly for filtering in distribution payments forward looking. The interest-bearing borrowings that up on the slide, just as a matter of correction, the 5.1, we just need to include a further 81 million rand that relates to an overdraft that's been allocated to current liabilities. So I think if you take that into account, it translates into a balance of about just under 5.2 billion. And effectively, if you look at the flow up to the date of presentation, I mean, we've raised net facilities of about 100 million at this stage. We've also had cash generated from operations approximating just under 90 odd million rand that is sitting in the revolvers as well. So I think effectively looking at the progression to year end on the interest-bearing borrowings as well. You know, we're expecting, like I mentioned, the disposals to contribute quite significantly to the reduction. CapEx of about 300 million rand, taking into account our distribution payments because our excess cash all remains in the revolvers. So at this stage and based on the forecast growth that we see in the business, another 320 million for H1 distribution, including the 255 for our Feb 2016 final. So I think to summarize, if you look at our net interest-bearing borrowings versus our income-producing assets, that is the progression we see from year end, the 47.21 down to 42.3. And barring any unforeseen circumstances in the market, we hope to achieve 40.8% at year end. Thank you.
Thanks, Shanil. Yeah, thanks, Shanil. What, as a young fund, young maturing fund, we've tried to be as detailed as possible this year. So for those of you who are used to our quick presentations, I think the more detailed, the better. And I think it's something that, the more informed the shareholders are, I think the more questions that they can ask and answer. Just out of the slide, I think it is in the booklets for sharing. A couple of key points for me. I think obviously the value in terms of the split, you will see that under sovereign, it continues to be the most dominant portion in terms of the portfolio. Where we have Office General, this we had a big debate. It does not mean that we've got 200,000 square meters of non-government in there. This is where basically sovereign is not the majority in those particular assets, and that's how we do classify it, because I think it can be misleading that we've got 204,000 of CBD office accommodation, which may scale a couple of people. So that definitely does not mean that. It means that in those particular properties, government is not the dominant tenant. The other number that I would like to mention is obviously our average rental. And now where there's a discrepancy between the 85 and 112 RAV, is a question that normally comes up. Are we over-rented? Are we seeing rent revisions? Again, I think you can see that we've consistently maintained that we're not over-rented. We've historically mentioned that government do not pay rates and taxes, and we do build it into the model, and we do recover it from them. This particular rate is skewed slightly. If you look at our properties in Polokwane, they are probably the best office accommodation assets in Polokwane, whether private or government. And I think we consider those true A grade, not government A grade, but true A grade. And their rentals obviously have an upward tick in terms of what our average rental per square meter is. So if you look at where we've done, and I think there's a slide later on in terms of where we've renewed our leases, there's been no rent revisions. And again, I think we do try and make sure that, I think we understand where our tenants are going. The big shift is that in our sovereign, and I will explain it a bit later, is that actually our biggest exposure is actually provincial government. It's not national government. So everything that is going on in Pretoria that drives people that there's lack of strategy and so forth is only about 28 or 29% of that number. The bulk of that, where we're seeing it, is at actually a provincial level. And at a provincial level, they are still signing 8% escalations, and they are probably are more able to sign longer-term leases, as the dispensation that is currently there does not affect them. So where you see those numbers come through, you can attest that to the provincial exposure. Also, the weighted lease expiry profile on revenue and by GLA. We buy these buildings on a month-to-month lease. For us, that's where the opportunity is. That's where the value creation is for us. We don't buy these buildings with 7 or 8 year leases. The reason why we buy these buildings is because we believe, and we've shown, that we can re-let these buildings. It has taken a bit of time. We are the first people to admit that between ourselves and our key tenants, we have not yet seen a big influx of those 7 or 9 year, 11 months leases coming through the system. But those discussions are well underway, and I think we have no doubt that those leases will come through. I think we are certain of our strategy. The longer term leases will definitely come through, and unfortunately it does take time. As you do more acquisitions, if you look at the redefined portfolios, an example, all of those 15 properties came on a month-to-month leases. So we have to then put it into the asset management. We have to put it through to our structures. We have to come up with selling the strategy to those particular tenants, and obviously renegotiate those rentals going forward. So I don't, I think I was mentioning it to somebody I was chatting to earlier. For us, this is where the opportunity is. If you recall where we listed, ideally, if we can get that number to plus minus the 5.5 year, I think we would have done well. Unfortunately, it does take time. Government does not make decisions, very, very quickly. And we just need to understand the nature of the beast that we're dealing with in our tenant. Our cost-to-income ratio has, again, also because most of our buildings are single-tenanted, 22.7% I think is a good number. Where we do have multi-tenanted buildings, as I've mentioned earlier, that government is probably the minority in those particular buildings. And given the age of the assets that we're buying, it does tend to be on the high side, and it's basically it's a symptom of the type of properties that we buy in the CBD areas. These are not 2-3-year-old buildings. These are 30, 40-year-old buildings, and there is a cost to manage these buildings. From the acquisitions, I think this has all been announced in the press. I think you would have seen the various SENS announcement. I'm not going to go into too much detail with that, but I think the one thing that I did want to mention is if you look at the respective yields that we bought some of these assets at. Some of them, unfortunately, we have had to put onto our disposal list, particularly Tembisa in terms of the retail portion, as our strategy domestically changed, as we saw, that sovereign is where we wanted to be, and I think it's something that we'll give you more update as obviously those transfers take place. The properties that are transferred at year end, Richmond Forum, SAPS, Bell, and Yarona, these were part of our disposals, and I think we have not included the transactions that the 551 million that Shanil has spoken about, which has already been signed up. We just need to basically conclude and receive the money in our bank. So as long as the money is not in our bank, we don't deem it to have been sold. But even though we have binding agreements at this stage. Just an analysis in terms of our tenant, and in fact, maybe I'm going to skip this because I think this is a new slide that we've never really showed before. Because historically, we used to mention that 60 or 70% of our income comes from government, and everybody thinks that it comes from DPW. Now, this slide clearly shows that national government, on the GLA perspective, that national tenants still form part of a bigger slug of the tenants. But when you look at the rentals, actually, that drops to 29%, and the provincial rentals, which is where our 8% are still very much intact, is coming in stronger. With the acquisition of Redefine, there's actually even more provincial and some local government properties that have been bought as part of that transaction. So we do anticipate that the net effect of national government as far as rental is concerned in terms of our exposure will decrease slightly. But for us, it all forms part of sovereign. An area that we do see once we've achieved our self-imposed targets in terms of strengthening the balance sheet that we would like to significantly grow is state-owned enterprises. I think between Eskom, Transnet, SARS, all of them have got huge capex budgets and projects that they would like to roll out. And I think some of them are already in the market. I think Eskom has already approached BROL with the strategic document that's available in the market in terms of what their property strategy will be. It's a very concise document that I think will offer landlords such as ourselves further opportunities going forward. Local government, historically we've always said that, we generally, this is an area that we don't play in. Local governments, have a high level of qualified audits, and that basically just spells danger for us or risks. But having said that, I think there's probably 4 municipalities that we'll like to have exposure on, and that's Tshwane, that's Gauteng, or Gauteng municipality, that's eThekwini municipality, really big ones, and obviously the Cape Town metro as well, municipality as well. Those are some of the municipalities that we're starting to look at. We've had very, very good traction now with the eThekwini municipality. We are talking in the region of about 30,000 square meters that we are currently engaging with the eThekwini municipality, which is where some of our guidance is coming from. I think somebody asked the question, why don't we just give shareholders, a 2% or a 5% growth and rather focus on our core portfolio and further reducing our gearing. Look, we are seeing some traction from those local governments. I think City of Tshwane is also announced, pretty aggressive plans, and whether Parliament eventually moves from Cape Town CBD to Pretoria, I think Tshwane will be a major node to play in. I think if you're not playing in the Tshwane metropolitan, I think as a landlord, particularly with sovereign exposure, I think you would have missed an opportunity, in our opinion. From a geographical spread perspective, I think Gauteng is very much the dominant area, as we've already mentioned, and then KZN, Limpopo, and the balance are there as can be seen. In terms of our grading, there's a lot of buildings that are going through capex, region of reinvestment and management to make sure that we retain those tenants that are in there. When we first listed, in fact, we had C and D grade buildings in there, so it's very much pleasing for us to see that most of the C and D grade buildings have actually completely disappeared from our portfolio. The tenant portfolio by rental, I think, is just further showing, what the composition of the portfolio is like. The one area that you will see that has slightly increased is the vacancy, which has been up to about 9%. As already mentioned, the 30,000 square meters that I was mentioning in eThekwini is not part of that number, so that will obviously go a long way towards reducing that vacancy in the financial year that we've just started now. In Pretoria CBD, we've had a request for information for 500,000 square meters in Pretoria. 500,000 square meters of GLA that the Department of Public Works has basically gone out to the various landlords to find out if there is space. They've started visiting some of the buildings. That will have a significant impact in funds like Delta. So ideally, we always like to keep a number there whereby I think 4% is the number that we normally say, particularly to allow our tenants to be able to grow within some of those properties. So 9% I think is an opportunity, and I think just given between what's happening in Pretoria with 500,000 square meters for request for information and some of the discussions that we are having with eThekwini municipality, I think we are fairly confident that number will come down by the time even by the time we present our half-year numbers in 2017. You will see big improvements there. The number of leases concluded, as I mentioned earlier, that we retained about 80% of leases that were expiring at the end of February 2016. If you look at the average rate per square meter that we are able to renew those leases, it's again, I think we keep hearing this message. Are you over rented? Is government looking, shopping the buildings around? Some of these buildings you cannot shop around. They need to provide services in particular areas. You cannot move a police station, just overnight. You cannot move magistrate courts. They need to be there because they serve a purpose. So, having said that, I think, to credit to my counterparts at national departments, I think they are implementing very, very rigorous treasury measures. And I think these negotiations have become a lot tougher from when we started entering the sector some nine and a half years ago. We're no longer seeing the 10% escalations. We are seeing probably in the range of between 6.5% to 7.5% escalations. So I think that the discussions are there, but I think we've got a very broad team. I think Otis, Sandra, and the rest of the team, and Mfana, I think they've done a sterling job in getting this number of renewals bedded down. There were obviously some 61 leases that were also relet. These were relet at 90 rand a square meter. Again, the escalation significantly above the touted in the press 6%. And that's predominantly because some of that number is not all national government, as I've already mentioned. Some of it is state-owned enterprises, some of it is provincial leases. Some of the major leases that have been renewed is obviously Beacon Hill in Eastern Cape, Metropolitan, and again, if you see the rate per square meter there, again, it speaks to the geographical location. I think for those of you that know this property, it's the only building in that area where government is. So that may seem high for people who are looking at a saturation of market in Pretoria or Durban or Cape Town, but in Eastern Cape, in Bisho to be exempt, there's not a lot of properties where government can move to. So I think we obviously do try and get a leverage where we have a leverage as well, in terms of where we know that we've got the right buildings that we can basically push through. Samora House, this is in Durban. This was done at a very good rental. I think when we first entered the Durban market, we found that rentals were sitting at 55 rand a square meter. In our discussions between provincial government and national and eThekwini municipality, given our dominance there, we've actually become the market maker there. And by that, I don't mean by bullying our way in. For those of you that came on our roadshow, you will see that the amount of capex that we spent on those buildings purely just meant our offering was far superior than anything else that our competitors are currently offering in the market, and government has come to that realization. And for those of you that walked around in 88 Field Street, the lifts have been changed, the aircon has been changed, new lift lobbies, and that building will really become an iconic building. And I think we've come to realize that if we spend the capex in these buildings, government doesn't want to be anywhere else. I think they want to be in the buildings that are functional, that are not dodgy, where the lux levels and they've got the right working environment. They're just like any tenant, whether in Sandton or any other place. I think this slide is talking about an update on government in terms of the second directive, and that I think this is where some of the confusion comes in. For those of you that do not know, there was two government national treasury directives. These directives were solely there to deal with expired leases, as DPW was having qualified audits. The Auditor General has got a very basic view. If your leases have expired and you continue to pay rental to landlord, there's no contractual obligation. They see this as fruitless and wasteful expenditure, basically. There's no contractual obligation to spend. What this is forcing government to do is basically to have valid leases in place. Unfortunately, it does take 18 months for government to renew their leases. So this is a major challenge that they are trying to resolve, and it's something that we are basically engaging with National Department of Public Works to try and shorten that period. But I think on the one hand, you have to feel sorry for public employees. On the one hand, they're trying to make sure that there's no, the public cannot say people are taking shortcuts. There's corruption in the sector. So the only way to resolve corruption is to make sure that there's more checks and balances in the system. But unfortunately, by having more checks and balances in the system, that just delays the length at which you are renewing those leases. As we've historically mentioned, National Department do use RODA as their source of rental. Whether you agree or disagree with that, we've actually engaged with RODA in terms of had some input into some of the notes, because we did not agree with some of the rentals that he had put into his latest report. And I think it was actually a very, very good discussion with that. And I think we see this engagement going for continuing going forward. One of the key issues that people, when you mention that we are a sovereign property fund, is about, is government paying? Is there austerity measures in government? Again, guys, we can sit here today and I can categorically tell you that government does pay. In fact, they've seen this as an opportunity, that they are busy implementing an automated payment of leases whereby individuals will not be releasing leases, so that we don't sit with the debtor's book, even if it's for a month or two. So this will be completely automated. This system will be able to pick up that a particular lease is expiring, and will by default build in the escalation as well. I think this is a major achievement. I've already mentioned that obviously we've received a request for information of 500,000 square meters in the Pretoria CBD. This is huge. This is very, very big. In fact, we were even looking, and we even said had some properties in our disposal list which were slightly below the 100 million mark, and Otis came to the executives and said, listen, guys, I think we may have an opportunity here. So we really are trying to make sure that we seize all the opportunities that are there. And I think there's the level at which the progress this is moving. We do anticipate that this will be filled up during this current financial year. From a provincial government perspective, I think it does operate independently of DPW. Whilst they all may be colleagues and have the same security from a balance sheet perspective, there's different relationships. I've always said, no single relationships. All of our relationships don't reside with myself as CEO. We've got probably about 6 or 7 government liaison people made up of some of the people. I can see some of my colleagues in the audience here who deal with these governments. Sandra is based out in Durban. She's best placed to engage with our tenants down there with her team, whether provincially or eThekwini. Otis manages around national government, Gauteng. I still manage along with some of the team here, our SARS relationship. We've got Trevor and his team managing, the relationships down in Cape Town. So it has to be a multifaceted effect, where there can never be a concentration whereby, if God forbid something happens to me, that basically our business value chain or our business is put at risk. So we do manage relationships amongst the groups, and I think it's currently working well at this stage. Local government, as I've mentioned, it's a new area for us, and I think we've actually been relatively and very surprised by just how professional by some of these local municipalities are. They're very, very eager, quick decision makings. Let me give an example. I think we took transfer of Shell House in Durban, and within basically a week and a half after taking over, and we had our first meeting, we had a letter of intent from eThekwini municipality that should we be able to spend the required capex, that they were prepared to be in that building for was it 10 years? 10 years in that particular building, which is is the type of speedy action that we don't sometimes give credit to some of these public servants. So I think there are some green shoots that we do see, and I think if we are able to use our dominant position, particularly in places like Durban and so on, I think the portfolio will continue to grow going forward. And what I didn't mention was that Shell House renewal is done at 8%. that the building is a strategic building. It's right opposite the city center. And in fact, most of our buildings, it turned out by default, were all around the city center building. So we're actually engaging with them on a far bigger strategy going forward. State-owned enterprises, as I've already mentioned, SARS, Eskom, DTI. We have received quite an attractive offer on our DTI campus building from the private party in that triple P. Ordinarily, we would have not sold that particular building, but the offer that we received was well above even where we had the building in our books. And I think the board was pretty happy to support that particular acquisition or that particular disposal, even though it formed part of our core business. So going forward, where do we see further opportunities? As I've mentioned, we've got very limited amount of exposure to Eskom. We've got very limited amount exposure to the likes of Transnet, even some of the provincial state-owned enterprises like Itala and the likes in Durban. We will continue to engage. Yeah, I've already touched on the internal DPW task team. This is very important for us. Just like any organization, your biggest tenant, as we've always said, 70% of our revenue comes from sovereign underpinned assets, and it's important that we engage very transparently and we have robust discussions with our biggest tenant. It's something that I think we can look forward to using further advantage of in terms of being ahead of the curve, in terms of understanding strategy. And we obviously are giving the public servants the perception that there's lack of direction, there's lack of strategy from DPW perspective. So I think those meetings are behind closed doors, very robust, and I think they are right down to even detailing things like, if on a 3-year lease, it makes it virtually impossible for us to import the type of capex that is required on some of these buildings. So they are under pressure from not only from ourselves or from the market, but also from their user departments to make sure that the buildings are well looked after. So I think there's a couple of strategic discussions going forward between ourselves, National Treasury, and DPW. Excuse me, I do have a cold, so if I still I keep sniffling, I'm just recovering from a cold. I'm going to try and go past pretty quickly here. I've already mentioned on the capex. I think as a fund, we are one of those funds that spend a lot of money on capex. As a result of what we're seeing and what we've announced to the market, not only for Redefine, not only for the AutoTouch portfolio, but for the existing portfolio, we've seen it very, very necessary to appoint new staff members, and I think you will be seeing maybe on our one-on-ones Andrew Schoeman. Andrew Schoeman is in the audience. He's comes out of ACOM. He's a QS by profession, and he's purely there to help us and leads our capex and projects division. I think Andres, brings a lot of experience and wealth of knowledge about refurbishments and obviously redevelopments into Delta. Trevor is still there. Sandra and the rest of the OPEX team is very much on top of our capex regime. The challenge that we do have is how between finance and our capex, we need to be spending capex in buildings where we are seeing